Let's turn our attention back to the markets now. We were talking about the pullback we've seen in the yields for the 10-year T-note, now at 159 after seeing a big spike last week. Let's bring in Chris Gaffney. He is TIAA Bank President of World Markets. Chris, it's great to talk to you today. You've sort of got this headline on your note that says there's a standoff essentially between the bond markets and the Fed. Who's going to blink first? We've got the FOMC meeting kicking off tomorrow. What do you expect?
Yeah, I think Chairman Powell's done a great job thus far in walking that fine line between encouraging investors about the future growth projections and still keeping the bond market at ease about interest rate increases in the future. So it's a push-pull between inflation and growth. Again, Powell has done, in my mind, a fantastic job so far, and I think we're going to get more of the same from him. We're going to see him confirm that rates are going to stay lower for longer. They're not afraid of the inflation. Everyone expects to see inflation jump higher as the economy opens up, but in Powell's mind, that inflation is going to be transitory, as he said, and I think he's going to give a clear message to the markets that they're going to keep rates low and allow the economy to possibly run a little hot in the coming year.
Yeah, the choppiness around what we've seen, I think, over the last couple of weeks, you can dig into maybe inflation expectations. And the one thing that kind of catches my eye is how that's widening depending on who you ask. It doesn't really necessarily seem like we have as strong of a consensus as maybe we did in years past. And obviously, we're kind of dealing with a tougher situation to gauge here. But how much of that maybe plays into some of the volatility we've seen and how that could play out ahead, depending on what we hear from Jay Powell?
Certainly. I mean, it's very hard to gauge what the impact of the reopening, the economic reopening, and then you add the stimulus bill that we just got passed. So we're going to continue to see these choppy markets. I think there's going to be this push-pull between growth and inflation. And again, it's going to be a contest to see who blinks first. And if Powell can hold steady and hold firm to his commitment to keep rates low and keep even with inflation running higher. And again, I think the key for Powell is going to be, wage inflation, and that's what we're looking to see. Once we start seeing some wage inflation, once we start seeing earnings go higher and work weeks extend, then you could see the Fed step in and start raising rates and pulling some of that liquidity back.
Chris, let's talk about your positioning in the markets, particularly outside of the U.S. We've had a number of guests on who've said that there is a bullish case to be in emerging markets right now. On that front, we got economic data from China that continued to show the significant bounce back that we have seen when you compare it to where the country was a year ago. And yet that recovery does seem to be a little uneven with the restrictions. We've seen the activity tick down in China as well. What's the case for investing in EMs right now, and how are you positioned there?
Yeah, we're positive on China. We think, the numbers that came out this week, and obviously, the major numbers were all over 30% when you compare them to a year ago, but erasing that base effect from the big pull down a year ago, if you even compare them to, the major ones, industrial production and retail sales to 2019 levels, it's still pretty impressive. Industrial production was up just under 17% compared to 2019, and retail sales were still up about 6.4%. We have seen a rotation away from internal consumption towards more external demand, and that was apparent in these numbers also. We're seeing the shift from consumption oriented to more external growth as the global economy comes out of the lockdown. So we expect to continue to see exports out of China increase. They're very impressive for the first 2 months. I think it was about a 60% increase over the first 2 months compared to last year. So we favor those commodity-based countries that are supplying goods and services into China, because China will continue to grow both internally and, as we are seeing, externally right now. So, that major economy, they're the first to enter the lockdown, first to exit. And I think it's the numbers coming out of there predicts good growth for the rest of the world as the rest of the world also exits the lockdown.
Yeah, on the commodity front, I think a lot of that resurgence in China spilled over into models predicting what might play out for oil around the world, because obviously them coming back online. You in your note highlight that you think $75 for the price of crude might be more realistic than $100 towards the end of the year. I mean, how does that maybe play into the fact that we've seen energy lead so far this year, and how much upside still remains for that sector, and how it should play in people's portfolios?
Yeah, I'm a little worried about. Obviously, I think we're getting near the top on oil prices, in spite of OPEC's efforts to reduce supply. You've still got the shale here in the U.S. and that offset the way OPEC tried to raise prices before. And we could see all of that supply coming back online. We certainly are going to see an increased demand, and that's what led to this surge in oil prices. But again, I think we're getting closer to the top in oil for the near term. And therefore, I think a lot of the gains that you've seen in the energy sector will start to stabilize a little bit. And I think there's better opportunities elsewhere.
Chris Gaffney, good to talk to you today. TIAA Bank President of World Markets, joining us there.